The broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen, and good morning to those of you who are in the Southern Hemisphere and just gone midday in New Zealand. Nice to have you all with us today, and my apologies for being a little bit late. We're 3 minutes late. Hello, Pete. Pete in Auckland says loud and clear, so Terry, thank you, says audio is good. Those of you who have been waiting on the video from the first follow-up webinar from the Los Angeles tutorial, which we held the first follow-up webinar last Friday, our apologies. Terry's been ill. He's suffering from vertigo, and we wish Terry a speedy recovery, but the work processes have been somewhat disrupted, so you'll have that in the next few hours, actually, those of you who are waiting on it. And for the rest of you, good to have you with us. Let's see, we've got a good, nice crowd today, again, as usual. Akshay, haven't seen you for a while, Alan, and the other Alan Varian. Alan Keane did a tutorial in Los Angeles. Alan Varian, Aussie bloke, good bloke, been to a tutorial in Taupo and responsible for us living where we are now in Talai, just next to Mudbury Bar. Alan, thanks for that tip. It's worked out nicely. We've got Boyd with us. Nice to have you with us, Boyd, gentleman of leisure now that you've retired. Very nice. We enjoyed having Janet at Los Angeles. David Volker, tutorial guy. Don Medell, so's he. Eric, so's he from Dubai. I don't know what time it is in Dubai, Eric. I don't know if it's civilized or not there. Harold, our gold bucks. Stay with us, Harold. We've got a lot on gold today. Jessica, nice to have you with us, Jessica. Jim Brown, Johnny Barnes. John Lispin, we've got a great crowd. Kurt, we're doing the Huey analysis for you, as you asked for. My friend Marcel, up there in Canada. Hope you're feeling well, Marcel. And Mark, you back from Perth, are you, mate? You are traveling the world. Good to have you with us in particular. Marilyn, nice to have Marilyn here. Mike Midsos. Mike, we missed you in Los Angeles. Hello, Tony D. Tony D. Domenico's with us. Pete Andrews, my old friend from New Zealand. First bloke that I ever taught the Daniel Code to. Still here, still alive and kicking, mate. He's a bit of a world traveller as well. Pierre, Richard, Peter, Better, yes, good. Can't go through all these. We've got a big turn up today. Sue Lee, always like to say hello to the girls. We don't have a lot of girls, so great to have her with us. And Vicky. We've got two chicks with us today. Crikey, and Bill Ford. Nice to have you all with us. Guys, we've got a whole lot to go through today. It feels like a really long time since I spoke to you, and lots of things are happening. So let's just run through the PowerPoint fairly quickly. Not everything is in the order that I would have liked it, but we've just got a ton of material to get through, and I've sort of put it where it needs to be, so that will all work out. Let me see if the screen's changed for you. Yes, it is. This is what we're going to talk about today. We're going to do a fairly detailed analysis of the Huey index for Kurt, who asked for it. And the Huey is an index of unhedged gold miners. In other words, it's a index created with the price levels of gold miners who do not hedge the sale of their forward production, and in that respect, it's a proxy for gold. You can't. There are no futures on the Huey. You can trade it with options, but we use it mainly as a proxy for gold. And some of the signals have been fantastic. Those of you who follow the fourth seal will know that we called the fourth seal low in November last year. Very good piece of work by Frank D.B., who helps me with the fourth seal analysis. Very, very good work. We're going to give you some fairly extensive analysis of that and what the outlook is. We're going to look at this question of options expiration, which I find fascinating. I hope you will. I don't profess to know anything about options really. I'm a futures guy, but just looking at the price levels and when these options expire, it does raise some interesting things to think about. You'll see in the process of what we're talking about today the great beauty of waterfalls and staircases. And I know Tom Tomjanovic is with us. His partner couldn't be with us today. He sent me an email, but they're using waterfalls with a degree of success. So should everyone be who's done a tutorial and knows about them, which is great. We're going to, we've got a question from Terry in Melbourne. I don't know where Terry lives these days. It's usually up on the north coast of New South Wales last time we talked, Terry, but I see you now in Melbourne. He's got a question about Brexit. The British exit from the Eurozone, which is going to be great fun, and he wants to know how that's likely to affect the Euro and the GBP currencies. We've got some analysis on that for you. And I wanted to just get up to date with some of the stutters going on in major equity indices. They're all still very highly correlated, but we're seeing them at significantly different levels, which is not a sign of great health. Normally these things are pretty well locked together, the major indices, Dow, Russell, NASDAQ and the S&P, and right now they're not. There's a significant degree of divergence, and I want to show you that and just get that to the front of your minds. And then, of course, a lot of this is about gold, because that seems to be perennial interest for a great many of you. Couple of charts here that don't really fit into anything, but we had some absolutely wild volatility today, which is great. I love volatility. But for those of you that are not using the Daniel code numbers, I wanted you to look at these charts, because if you're not using the Daniel code numbers, you have no hope. And I know a lot of you are very happy to be in that position of battling on without any hope. But how in hell would you know where these markets are going to turn, or in this case, stop and collapse? And what you're looking at now is actually T-bonds. Let me make sure that you can see this screen has changed. Yes, you can. And you can see that in the members charts, we had 171.08 as one of the levels for the UST bonds today. We just had massive volatility. This thing roared up and roared down. Great drama, supposedly put down to the shooting of an MP in England, which is a pretty lame-o reason for markets to do this. I think it's quite what makes the US bond markets move in this way, but I doubt if that's one of it. But, you know, journalists have the job of fitting today's news to yesterday's price action, try and make sense of it all. More likely was that we had a rush of blood in the T-bonds, which incidentally are on a blue line sell signal from the Daniel code. And they roared up full of enthusiasm. Look where it went to. There's the Daniel code number, the blue line, sitting there at 171.08. And T-bonds today made its high at 171.07, just one tick, 1/32 of 1 point away from that blue line. And that's where it failed and ran all the way back. And look where it closed. The earlier blue line, there was one to 169.27, and this market closed at, you ready, 169.27. I'm not even going to pretend that all of these markets are as accurate as that, but it's pretty scary stuff. And if you're not already aware that markets run and turn at these Daniel code numbers all the time, you should become aware of it pretty quickly. And we're more than happy to give you a free trial at the Daniel code so you can see these charts and get an understanding of why markets do what they do. Basically, all markets are ruled by the Daniel code numbers. So plenty of drama, huge volatility. With the Daniel code, it just makes the numbers more accurate, which is great. A couple of other charts. I just want to show you the same idea here. This is gold today, which was on a TO3 sell signal for us. Where was it going to turn? I mean, it opened bullish as anything, 131, 1316.1 was the next blue line, and there was the high at 1318.9. Huge enthusiasm, but that was the point it turned. And here's the same thing in silver, which was also on a TO3 sell signal, and it had the added strain, I guess, of trying to break through the Daniel Code black line, 1781.5. That's the last level of support and resistance in the operating swing. And it works slightly different to other lines. It's very, very powerful. I don't know if Webby's with us today, but the Daniel Code black line will stop a train. If it's going to bite, it's the most powerful point. You can see this market attempted to breach through its blue lines, and then it hit the black line, which works on a closing basis mainly, and it absolutely killed it. And down it went almost exactly to the first retracement of the minor swing. So just want you to be thinking about that. If you don't have these Daniel Code numbers on your charts, you are losing a huge edge. In fact, I don't know how you can possibly understand market structures without the Daniel Code numbers, but you'll see more of that as we go through our analysis today of the various markets I want to talk to you about. Here's our compliance statement, which I suggest you take very seriously. Trading futures and Forex has risk in it. And if you don't know how to trade the Daniel Code way, it has more risk in it than you can possibly imagine. So I wanted to make that point to you. Okay, let's move on, because it just seems like an age since I spoke to you last, and we've just got so much stuff to talk about and go through. This is the options part of it, but I actually want to start first of all on the analysis of the Huey. And Kurt's asked for this, but I know a lot of you are interested in this as well. So we'll start off with the 6-day chart. And you can see that back here in November, we called the low of the Huey almost exactly to the day. Frank DB was doing most of that work on our fourth seal analysis, did a wonderful, wonderful job. And then we had the last bar came on January 22nd, which was a false break. And fast moves come from false breaks. And since that, we've had this beautiful sustained rally. Where did it go to? Well, same thing. Let's think about those Daniel Code numbers again. We had a black line of the minor swing was at 243.25. The high of this whole rally in Huey has been 241.78. Not bad on a 6-day chart. Let's go now and look at the 12-day chart, and you'll see the same thing. This market is absolutely ruled by the Daniel Code. It ran down from its big, this is the big dramatic fall from grace that we had since September 2011. This is the forecasting of the low. In here it started, went all the way through. Look where this market bottomed. This is the Daniel Code retracement. I'll pull this in so you can see where it is. This is the major swing here that runs from September 2011 down to this low in November 2000. You know, it's an 11-year swing, and you put the Daniel Code numbers on it, and the black line, the last level of support and resistance in this market, in this swing, comes in at 101.67. And just look at how this market just sucked on this number. 1, 2, 3, 4. Little rally, another 1, 2, 3, 4 bars all around there, including some extremely accurate. 102.96 was the low there. And then you had this false break, and off it went. And where's it gone to? Well, it ran from the 59 retracement, the 89 retracement, Daniel Code black line of the major swing, straight up to the Daniel Code black line of the minor swing. It is incredibly accurate, this stuff. So Huey is moving, Kurt, exactly as we forecasted to do in the fourth seal coverage of gold. Huey and gold are very highly correlated. That's why we use it in that manner. And really, I guess what you all want to know is what's the future. Everyone wants to know the future, don't they? We know the past, so we always want to know the unknowable. But let's have a look what clues we can get from this, because we can move out from here onto our 24-day chart. Now, this is a chart in which every bar on this chart is 24 trading days, which is a little bit more than a month. Most months have 22 trading days in them. These are very, very powerful signals. And if you look at this going all the way back to October 2000, we're looking here at our waterfall and staircase patterns. Those of you who've done a tutorial will know what this means. It's one of our methods of recognizing trend in a format that others don't. The other one is the DC trading channel. And the third method of finding trend is from the fourth seal. But this is a very visually impressive case, because this is a 24-day chart. That means it's very much stronger than the other charts. And have a look what's been happening with these. This is all the way back. This is 16 years of data. All of these moves up have started with a staircase. The significant move down have been a bit different. We've had a waterfall back in 2003 that didn't do an awful lot. It was just a correction. Then it was reversed back up again by a staircase. And then we had a waterfall here in September 2008. Again, the big correction, then reversed by another staircase, and right at the all-time highs here. We didn't get a staircase pattern, but we did get a DC channel fail pattern, which is what sent it down. And right down here, now we're in a new staircase pattern. You can see here, same thing on the chart, that it's run up to its correction of the minor swing. 243.52 is there. Let's see what we had here. Same thing. This is the same swing. Here it appears to be 1, 2, 3, 4, 5 swings. When we go to the 24-day chart, it's just concertina down to be 2 swings. But it's the same number, 243.25. Same bounce off the black line from the major swing. Same rally up to the black line of the minor swing, but what we have here is the start of a staircase pattern on the 24-day chart, which is pretty rare. In fact, this is only the 4th one we've had since October 2000. So this is the 4th staircase pattern setting up, the 4th in 16 years. So we have to say that this means something. You can see for yourselves what the previous staircase patterns have led to. There's one. There's 2. And there's 3. In other words, they've been strong and they've been long. Remember, each of these bars is 24 days. In other words, it's a Daniel code month, if you like, a bit longer than the calendar month. And these are multi-month moves with a fair bit of velocity in them. And the angle of attack we have on this present rally is very steep. We're, of course, probably at a good point now for a correction. But there's a real chance that this move is going to have legs, just simply from the fact that this is only the 4th staircase buy pattern we've had in 16 years. And as you can see from this chart, they tend to be long. We've had 1, 2, 3, 5 months here. The other ones have lasted for very, very much longer than that. You can see that 5, 7, 8, 20, probably 35 months plus. And if we can hold this, we're going to get a very serious correction of the staircase pattern. Of course, this is still a bear market, but the trend on the 24-day chart is up. And when that happens, we can expect much more out of this market. So those of you who are gold bulls, keep breathing, keep puffing. This might be the best chart yet. So this fits in nicely with our fourth seal analysis, where we told you about the low in November last year. As I say, Frank DB, who helps me with this fourth seal forecasting, picked that almost to the day. Very, very well done there, Frank. Absolute kudos to you. And we've been saying on a fourth seal basis that the trend has been up since then. And you can see how precisely it's ticking off these Daniel Code numbers. It's the market's way of saying to you, I know these numbers and I'm tracking them. And once we get a break out, a close above the 243.52, then of course it'll start to track the higher numbers, and we'll make sure you know all about that as we go. So plenty of possibilities for gold and Huey. Remember, these two markets are very highly correlated. When we do the Huey analysis, essentially we're giving you the major trending directions in gold as well. So that's particularly strong. Okay, let's move on and have a look at this interesting question of options expiry. Now, this is the natural gas chart. The red diamonds are the options expiry dates. Now, as I've said, I know nothing about options. I don't pretend to know anything about them. I've looked at it a few times. It's all too complex for me. I'm a humble country lawyer and I like to stick to things I know. And futures is my caper. But what's really interesting here is that you have a very abnormal distribution of closes, excuse me, against trading ranges. So the red lines that have gone on these charts are fourth and fifth seal lines. And I put those on just to satisfy myself that these are moves that were expected from the charts. They're in conformity with previous prices. So, for example, you can see that this high up here where we are right now comes from this low back in February and through this high in April. So these two prices in February and April forecast this high where we are today. And that's the same for all of these red lines, and they're on there for me to prove to myself that these are normal moves within what we could have expected. In other words, whereas there are a wide number of fourth and fifth seal lines, all of these options expiration days or the day before went to one of these foreseeable Daniel Code levels. So that makes them all valid. So that part's fine. So let me take them off as they're cluttering things up. And have a look. This is not only for options people, because options, these options expiries very much mirror the contract rollover in futures as well. And don't forget, there are different types of options. There's European options and American options, and some only expire on expiry dates. Others expire on a daily basis, or can be. And of course, you can use futures to close out of options positions, etc. All of which is a science unknown to me. But just have a look what happens during these price levels that back here, this is the start of this options period, or the start of it comes just after the contract rollover. And this is where the market traded all month, or the whole of the options period. And it managed to open outside that range entirely. Then let's move on to the next one of those, the next period, which starts here and covers this period here. And this is the only one of these that's really a natural distribution. If this was simply a natural distribution of markets, you'd expect the vast majority of these options expirations to be somewhere around the middle of where these trading ranges are for the period. That's just simply a natural distribution. So this one came. Here's the this is the 50% number, which is just about where it opened on the day of options expiration. So that's normal, but that's the only one that's normal. And if we look at the rest of these expirations, this is the start of this period, and this is where it traded. In other words, if we can get this to extend itself a bit and oblige us, and you can see that this is not right accurate about there. Here's the other one. This is the second out of three that's closed, or the options have expired completely outside the trading range. So, I mean, this is of interest to futures traders in particular. I've noticed this a lot lately. This capacity or tendency of markets, when they get close to the close, which is this little R on the bottom, this is rollover day. And let's take this fellow here. Here's the next rollover. This is also the options expiration day. Again, this market's closed on expiry day or rollover day, if you like. It's close enough. There's only a few days difference between them. Right outside the whole of the trading range. So that's, I don't know, is it 2 out of 3 or 3 out of 4? Here's the next one. It starts in this period here. We'll push this out a bit to make it a bit easier to see. Excuse me. And here's the start of this trading range. And here's the close. And this is this options period. The close of the period. Here's the high. Here's the low. This is down past the 74. In fact, the open's between the 74 and the 89. In other words, this is way outside the normal range you would expect this to happen on. Let's go on to the next one. I'm trying to show you a pattern here, and you may not have got it yet, but we'll certainly sum it up. Here's the next period. It starts here. Once again, here's the low, here's the high. Look where this thing has closed at. There's only, I don't know, is there 2 bars out of 22, 23, 24 that are anywhere near the closing price. In other words, we continue to see this pattern that going into options expiration and going into the contract rollover, we get these extreme ranges. Here's another one. This is what Australians call a skinner, like a few we've had already, and that means that very few people got anything out of this. Look at this, is right at the absolute top of the range. It's options expiration today, and you've got maybe 2 days, 3 days out of the last 23 that have traded anywhere near this range. So I want you to be aware of that, because what we've seen lately is an awful lot, and I mean, it happens all the time. It's just I've been thinking about it lately, is that we've had an awful lot of futures contracts. Same thing, of course, happens in options, that when they get close to rollover or options expiration, they kick off outside the range. They just keep going until the range is over. And once they close out, then you get the reversal and the revert signal. And that's exactly what we've seen today in gold and silver, both of whom have been very overbought just on a short-term daily basis. But they pushed on and pushed on and pushed on. And I was very much expecting that they'd continue to do that until the options writers had closed out their positions and put all that lovely money in their pocket. So I just want you to be aware of that. It applies to on other markets as well. I also pulled out the gold. Has the same characteristics. That's natural gas. Let's have a look. Here's gold. Here's the options expiring today. See how this push-up's gone on and on and on and on. Takes out the high. Now look what's been happening with this market. Here's the old high, taken out, correction. Here's the old high, taken out, correction. Here's the old high, taken out, correction. Here's the old low, taken out, turn around, big rally. Now, why is the market doing this? The market's doing this because it's searching for liquidity. And those are the places of maximum liquidity. This is a daily chart on gold. And that's where the swing traders have their stops, and that's where maximum liquidity occurs. But it's an interesting pattern for you to be aware of. Markets do this all the time, and you can say, oh, well, look, this is just a trend, higher highs and higher lows, but it's not. We've had higher highs and higher lows through here. Now we've got a higher high and a lower low, and now we've got a lower low and a higher high. So what these are, this is market searching for liquidity. And this is what markets do when there's no real trend in them. Now, as we've seen with gold, there is a real trend, and that's where it went to. So, you know, we've had these sell signals for gold and silver all the way up here as this has got overbought, but it took until options expiry for it to clear its way through. It's hit all the stops. The stops are all above here. This is a hook trade for those of you who've done tutorials. So is this. This is a hook sell. This is a hook sell. This is a hook sell. Excuse me. And this is a hook buy. And this is a false break as well. And now, but what I mean by a false break is I can just extend this and show you. This is a false break. That it's just there's 100% of the previous swing down is right where this line is. It just pushes through that. This line's not quite straight. Let me put on a straight one for you, make sure this is correct. This is the old low here. What this market's done, it's run down, it's stopped right at the 100% line, and then it's just pushed through a few ticks, enough to gather all the stops. And once it's done that, what have you got down here? Rollover. This is an options expiry period on the Friday here, the day before rollover. There's your options expiry. Here's your contract rollover. These are optimum times for a change in trend, and a lot of this is fueled by the options writers. I lost interest in options early on because I was able to prove to my own satisfaction, not to anyone else's, which doesn't really matter, but to my own satisfaction, that options are systemically mispriced. And if you're buying options, it's very, very hard to overcome that difficulty. You know, if you're paying $11 for $10 notes, it's very hard to find the way to put value back into that. So futures was the game for me, which is, of course, futures has a cost and a bias as well. But it's interesting that the options writers are one of the most powerful forces in the market. And it's interesting to see how this trend of a push out on options expiry or contract rollover goes on and on and on. We can see it more because of the difference in the rollover date. Some of these markets only roll over 4 times here. Other markets roll over very, very much more frequently. We see it much more easily when we look at the options expiration than if we only look at contract rollover. Okay, so that's what I want to alert you to. It's an interesting thing. I don't know if we can find a tool to make that pattern more obvious, but it happens in all markets, so it's something you should very much keep an eye on. Okay, next question for the day is Brexit. Let's have a look here. We've done that. You've talked about waterfalls. You saw that. I'll just show you that chart again because I just find it so extraordinary. This is the 24-day chart for the Huey. And I'm just showing it to you again because it's so extraordinary that we've only had 1, 2, 3. This is the fourth staircase signal we've had on the Huey, which is a proxy for gold. This is the fourth staircase signal we've had since October 2000, the fourth in 16 years, which really shows you something about these cycles here. It seems to me it's a very, very powerful signal. We've known that from our own trading of it on daily bars, but here it is on a 24-day chart. Wow, you've got to be amazed at that, and you've also got to be amazed at the way this market, like all of them, is absolutely captured by the Daniel code. Bounced off the 101.67 major retracement, first port of call, 243.52, Daniel code black line on a index, on the Huey index, and the high there, 241.78. Absolutely marvelous. Okay, Terry in Melbourne, who's a tutorial guy, lovely guy. Had a great pleasure of spending some time with Terry over in Waiheke Island at the December tutorial, Terry. And you wanted to know about Brexit. Let's have a look. We've got here something for you. GBP, USD. Here's Brexit. For those of you who don't know this stuff, this is Britain exiting the Eurozone. And they're having a vote on that in a week. Americans won't be concerned about it, but a lot of European people are, and traders, of course, are interested to know what's likely to happen. The main, obviously, main markets here are the gilts, the British bonds, and also the currencies, the British pound and the euro. And Terry's question is what's going to happen? Would I like to make a prediction of what's going to happen? Well, not really, Terry. It's not really tracking well enough to put your hand on your heart, but I've got a pretty good idea what's going to happen. Now, first of all, understand how volatile this market is. This is, you can see, this is the operating range in here. The latest operating range is running from 1980 down to the lows in 1985. And since then, it's just been waffling along the middle, but the joys of Forex trading and the leverage that we get from Forex trading and currency has allowed us to magnify that greatly. This currency is inherently overvalued and has been for a long time. This is a function of, I think, Britain being very much the lesser of many evils in some ways, but the British economy is not terribly robust. Their political system is a bit of a shambles, like ours is in Australia, and probably yours is wherever you are as well. But in many ways, it's been the lesser of other evils, which is why it has been so overvalued for so long. But you can see that basically since 2008, it's been trading in the same range. Interestingly enough, we have a current, this is the 24-day chart. Again, this is a very, very strong chart. We have this under the influence of a waterfall system that started back in September 2014. That was the start of the latest waterfall pattern. Since then, it's been reliably down. This is just a counter trend bounce here from May 2015, 1, 2, 3, about 4 months. That was just, a lot of people thought that was a low. It wasn't. It was a counter trend. Now we're right down here at today's close, 142.03 British pound against the US dollar. So we are, Terry, you want to know what's going to happen here? My best guess is very little because, the media, financial markets, lots of people, almost all people, love a bit of drama. We have the Y2K crisis. It's going to be the end of the world. We've all got to upgrade, buy this, do this, buy new computers. I mean, just a complete con. Whatever else the latest fad is going around. The reality is that these are massive, massive markets, and it takes some real and cogent reasons to move them. Now, this is still trading within the operating range. It's getting very close to the bottom of the operating range, but that's where it is. We had a little false break. Here's a little false break of the operating range here. And Albert, here's a false break for you again. Have a look at this. This is a 24-day chart, but it's the same thing. Here's the old low here. There's the old low. Just pushes through enough to get all the stops and off it goes. This is the false break up here. Here's the old high here. And here's your false break, just pushes up enough to get all the stops. And then it ran into a waterfall pattern, started its downward trend. I think the probabilities are that this is close enough to a major inflection point. This is the major inflection point here, this low. This is February 2009. If it were to take out that low, it'd be lots of headlines, lots of drama, plenty for all the scribes to scribble about. There's a certain belief that Brexit, if it gets up, which I think it will, is going to be detrimental to Britain economically. I think that's a whole lot of rubbish, and I think that's just a view peddled by the establishment who are pro staying in the European Union, which is something you'd really have to scratch your head about why that's a good thing. The European Union has just become a complete farce. Then you get to the idea that you have unelected government that can't be changed, and you hand over management to technocrats who are really mainly the people who pull the strings are ex-politicians, and they're in the business of picking winners and losers. And if you think that's a good way to run a business, which is what the European Union is at heart, it's a successor to the old European steel market, then that's a pretty crazy idea. So I don't think there'll be anything bad about Brexit. I hope the British follow the way the polls are leaning now and get on and do it. There's a number for you in that little cocked hat down there, Terry, which is going to be sitting at around somewhere around the next Daniel code retracement down. You can see how this market has run up to the Daniel code 171.05, little false break at that number there, runs down, gets support before this number, little false break of this number 147.47. Excuse me, the next number is at 131.36, and we have a cocked hat there from two Daniel code 4th seal and 5th seal lines. And I think if we do get a break of those lows, which is highly probable, if Brexit is approved, that's the sort of number you're going to be looking at for it to stabilise around. So I hope you find that interesting. Okay, let's move on now. That's Terry's question dealt with, and Kurt's question on Huey and gold dealt with. I wanted to just now take you, if I could, to the 6-day chart. And show you this issue of the dislocation between the US equity indices. Yes, here we are. Let's start with the S&P on the 6-day chart. Here we are. This is doing pretty much as we said it would. Brian, I don't know if Brian's with us. Brian up at WeWar. Let me see if he's with us. He's a good bloke. He might be out looking at the, yes, Brian's there. Brian, hi mate, good to see you here. Brian sent me an interesting email the other day saying that he'd found something in Twitter where some bloke called Edward Dowd, Mr. Dowd, had posted on his Twitter account that he said something like, my technician from the Daniel codes just emailed me, and it's all over. The Dow's closed below something or other. And I don't know anything about Twitter or Facebook or any of that stuff. The company actually has an account which Terry occasionally updates, not very often. Terry should be much more aggressive with that, mate. But I know nothing about it. I don't even know how to use those things, nor do I want to. But I got my daughter last night after you sent me that, Brian, to find that post, and they're all so excited about what the technician from the Daniel Code has told them. Well, You don't have to worry about that stuff, folks, because if you want to know what's happening in markets, you can just log on to our free webinars every fortnight. I know Americans don't use that term fortnight. It's for an abbreviation of 14 nights, a British expression meaning 2 weeks. And you can log on to these free webinars every fortnight. I'll tell you exactly what's happening with markets. And we have never said that it's all over. What we have said is that we were waiting to see if we got a close. This is our S&P chart. This is the index. And we got a close on February the 10th below 2 standard deviations from the mean. And just to refresh the memory of those who have not seen these charts, this is the S&P. This is the 2009 crash down here. And this is this market up to date. And in the whole of that period, with the exception of these 3 little outliers here, in that whole period of 7 years, it's been contained within the Daniel Code trading channel. And now what we have now is a new Daniel Code trading channel that is pointing down. Okay, so this is the new Daniel Code trading channel. Take me a moment to get this right. That's pretty well much what it looks like. We had a break outside 1 channel, means it went to 2. And what I said when we had that is that there were 2 probabilities. The option with the greatest probability is that it tries to regain the median. Let me take that last one off so you don't get confused. This darker blue line through the center here, this is the median of the Daniel Code trading channel. To do that, it'll try and regain this first line here. This is 1 standard deviation below the mean. And if it can hold that and consolidate there, it will try to regain the median, which is this line here. And these are great places for markets to fail. So don't be put off by the fact that this is all taking time to develop. It's quite one of the options. The most likely option is we have a long sideways consolidation here, but it will be guided at all times by the Daniel Code numbers. And that's exactly what we're getting. This is just as we expected. This is very normal. It's now at 1 standard deviation. It's just tracking above and below it, trying to gather enough strength to make the hop up to the median, which is up at about 2225, 222, 2230, around that sort of area. Now there's your 6-day chart. Let's have a look what's happening on the other markets. That's the S&P, which is the broadest market. Here's the Nasdaq. Here's the Russell, which is the small caps. Now, usually these markets are all very much locked together. You can see the Russell is considerably weaker. This is the same period of chart. This is March 2009 all the way up. The Russell has broken down below 2 standard deviations from the mean. It's actually gone to 3. Okay, we can drop these things down. It's gone to 3 standard deviations from the mean, and it's struggling, it's battling to hold 2 standard deviations from the mean. In other words, it's considerably weaker than the S&P. Then look at the ones that are strongest. Here's the Russell. As you can see, it's fell down to 2 standard deviations from the mean. It had 1 little close under there. This is 1 standard deviation from the mean. This is the first sign of a change of trend, but it can also reverse itself and fight to get back to the mean. And look what it did. It went straight back to the mean. All this big rally from this February low. This is the Needham low, which some people call the Jamie Dimon low because he's a famous person, got a lot of publicity. But we had all the buy signals going nuts down here for those of you who follow these tutorials. And this rallied from a break of the 1 standard deviation below the mean all the way back up. This is 1 standard deviation above the mean. In other words, and this little pullback at the moment has taken it back to the mean. In other words, this market is 2 standard deviations from the mean, almost 3 standard deviations from the mean, stronger than the Russell. This is the Nasdaq. This is the tech index. And then we can go to the Dow. as the final market we want to look at here, and it's doing the same thing. It's doing the same thing. Here's your 2009 low. See how this market's been perfectly controlled by the Daniel Code trading channel, all the way up, all the way up, all the way up, hit the fourth seal. This was the cocked hat episodes up here, and down it came. Just 2 standard deviations from the mean is the bottom line on this page. Here's the close, and that's as close as it ever got. It arguably never closed outside 2 standard deviations from the mean, or it might have closed right on it. It's just hard to tell on this size chart, but it doesn't matter. It gives you an impression of how far it's dropped down, and it's rallied back up to the mean. This is the mean up here, the center of these lines. So you've got the NASDAQ even stronger. It's been running from +1 standard deviation to 0 being the mean. You've got the Dow running from 0 heading down towards -1. You've got the S&P at the 1 standard deviation from the mean, and you've got the NASDAQ struggling to hold 2 standard deviations from the mean. You can take 2 things from this. You can say either this is simply a picture of relative strength between the indices, the way they're grouped. That NASDAQ is strongest, Dow is the next strongest, S&P is the next strongest, and the Russell is noticeably the weakest. Or you can think a bit further about that and say that when these in normal, now every one of these markets I've showed you since 2009 has been exactly in the same position on the Daniel Code trading channel. They've tracked each other in not tandem, not triple, quadruple. They've tracked each other in relative strength all the way through, and we're now seeing a divergence from that. We're starting to see that the relative strength is no longer there, and that sort of divergence, in my view, is something to give concern. So we want to start taking a really close look at what could happen from there. We know that we're in a corrective phase. We know there's a fair bit of instability in here, and we know that this the US Fed, which is the only one worth worrying about because it controls the reserve currency, we know that they're struggling. They're under enormous pressure to raise interest rates. We've had now 8 years of near zero interest rates for those who are fortunate enough to be the beneficiaries of it. Of course, that's not people like you or me or any businesses we're associated with, but they've set themselves on the path to raise interest rates, and the market is really now telling them that that's going to be a risky old thing. Markets that correct are healthy markets. Corrections are healthy for markets. It allows them to stabilize. It allows new areas of support to be established. Markets that correct are safe markets. Markets that never correct or that are not allowed to correct become dangerous markets. And it may well be we'll see something exciting in the future. So I'll be talking to you again, God willing, in a fortnight, and we'll really look at that issue of where to look for the break from these markets. The only other thing I wanted to show you is don't forget this very slow developing trade here, which is in the Aussie. I think there's, here you can see this is the Aussie USD chart. It had this period of insanity here where it was worth $1.08, $1.09, $1, 108, 10. Did it ever get to 109, 108? It certainly did there against the US. Quite crazy. And it's been correcting. It's been following the Daniel Code numbers down nicely. This was target recognition here back in September 2015. Same thing here, Albert. This is a false break of the old low. Rallied up, went straight to the Daniel Code number 78.31. This high 78.35. This is a very interesting market because the Aussie economy is in a considerable amount of trouble. This is a market that's been built entirely on minerals. This is iron ore and coal have been the drivers for all of this enormous period of affluence we've had. Basically, it's been wasted. The successive governments have failed to capture a proper proportion of that enormous success and natural wealth for the population or to build infrastructure. It's basically being wasted through complete incompetence, and we have an election coming up in about 3 weeks. I'm sure here the Liberal National Country Party coalition will be returned again with a much reduced minority. Would have been a great chance to throw them out on their ear, but Labor was just so bad under the Rudd Gillard years that it's too soon. No one's yet forgotten what carnage they did to the economy. But I think there's going to be a period of good political instability. When I say good, I'm a trader. I love chaos, and stability is the last thing I'm ever interested in. So keep watching this. Next number down is 67, then 65. And you'll see the bottom number on this chart, which is the 89% retracement of the major swing, is way down at 54. It's going to be a long time before it gets there, but I think there is a reasonable chance it will get there. Excuse me, and it should certainly right now be down around that 65 level. So that's what I had to tell you. Any questions, please type them in now, because we're getting towards the end of our hour. And I don't see any questions. Usually we have questions. What have we got here? No questions. Okay. Everyone's happy with all of this. That's great. David Vockler, yeah, all our friends here. Nice to have you all with us. Well, that's it, folks. If we've got no questions, that's the end of the webinar for today. Nobody's sent me any notes that you've stopped hearing us, so I assume you've heard it all. And Rob's with us. Hello, Rob. Rob H., my mate from New Zealand. Good to have you with us. I didn't see you here earlier, mate. I hope things are going well for you over there. And I guess you're glad that you're not in the dairy business, because dairy prices in New Zealand are taking a hammering. And it's going to be tough for a while for those blokes. Okay, David, glad you enjoyed it. Everyone else, thank you, Rob, my friend, and thanks for that, and John Lisserman as well, John down there. How are the Daniel codes generated? Charles, it's very interesting. They come straight out of the Bible. I know no one likes to hear that. Usually people puke about this stage, but anyway, they do. And go to the website. You can read all about it, read the articles. Start at the first one. Charles, it will show you exactly how the Daniel codes are generated and where they come from. Okay, so thanks for being with us, guys. I'll talk to you all in a fortnight, God willing, and enjoy your weekend. It's now Friday, almost Friday afternoon here. The rain is coming on Sunday, so I guess I better take this few hours and do what I normally do on a Friday afternoon, and that's head to the pool and crack open a bottle of tomato juice and mix up some Bloody Mary. So thanks for being with me, and I'll see you next time. Bye-bye.